Welcome back to this week's market update. Today is Monday, March 3rd, 2025, and with that, we will jump right in. Heading right into last week's market news, it was a negative week for the Nasdaq and the S&P 500 as strong but underwhelming Nvidia earnings failed to excite investors and concerns over potential new tariffs added to market volatility. By Friday's close, the Nasdaq Composite dropped nearly 4% last week, followed by the S&P 500, which was down almost 1.5%. However, on the other hand, we saw the Dow Jones Industrial Average up just about 0.5%. And in the fixed income realm, we saw the Barclays Aggregate Bond Index up 1.3% last week. It was a pretty busy week for economic data, so we will jump right in here, starting off with the PCE inflation report for the month of January that came out on Friday morning of last week. PCE inflation rose 0.3% month over month on both headline and core measures here. On an annual basis, headline PCE was at 2.5%, while core PCE was at 2.6% here. So both fairly moderate numbers, definitely a little bit higher than what the Fed would like to see. But as you can see here on this headline number, at least, it has been trending up since September. So that's something we do want to keep an eye on, especially as the Fed looks to potentially cut rates further this year. Inflation will be one of the key measures they're taking a look at. Alongside the January PCE inflation report, the U.S. Bureau of Economic Analysis also releases really great data on personal income, spending, and saving for the month. Here you can see personal income rose a very strong 0.9% in the month of January here, while personal spending actually fell 0.2%. Now, January can be a bit of a choppy month as consumers' pay stubs reset to the tax brackets for 2025, and it is also a slower month typically for consumer spending anyways. So it is a really big disparity here, but there are some other factors at play. And ultimately, with the pace of income growing more than the pace of spending here, that led personal savings to rise to 4.6%. So very interesting here. We'll have to see how this trends in the coming months. If it's just one choppy month here, or if it becomes a trend of consumers kind of pulling back and saving more. Moving along in our week here, we also got the Consumer Confidence Survey for the month of February from the Conference Board here. Consumer confidence fell in the largest one-month drop since August of 2021, so it was quite a bit of a decline. You can see here the present situations and the expectations indexes both fell pretty sharply. In fact, the expectations index is near this recessionary level here. Now, this is just one indicator. You can see it's been in a recessionary level for a few years on and off, and we have yet to see an actual recession, but it's not a great sign when things are trending towards recessionary signals just in general. Ultimately, this drop in consumer confidence came down to three things. We saw consumers become more pessimistic about future business conditions, future job prospects, as well as future inflation, with the 12-month forward-looking inflation outlook jumping to 6%. So consumers are expecting inflation to be about 6% in the coming year. Looking at current data, this would be fairly unlikely unless tariffs and other economic conditions really add to inflation. This becoming reality would be very unlikely, but we'll have to wait and see how this pans out. If this is just 1 month, a few months of choppy consumer confidence data, or if it becomes a greater trend and we do start to see those recessionary signals tick again. Wrapping up our week, we had two final economic data points that are also kind of a bearish in the short term. Now, they are both very high frequency data points, so we don't want to take them as fact, but they are important to take a look at and be aware of. So first, initial claims here. We saw initial jobless claims for the week ending February 22nd rise to 242,000. Initial claims up 22,000 from the prior week, and it's also about a 4-month high since early December there. This comes along other sides of a slowing labor market, including weaker consumer sentiment and confidence, like we just took a look at, as well as slowing payroll growth that has been in the statistics in the monthly labor market reports, as well as some slimming down of the federal workforce. So it's unclear to see if this recent uptrend in initial claims is going to continue on and become a long-lived increase in the unemployment rate, or if it is just a few months of volatility. Last but not least, the Atlanta Fed's GDP Now model now suggests that the first quarter of 2025 could see negative GDP growth of around 1.5% decline. While the model is very volatile and tends to be more reliable later on in the quarter, its latest reading does align with other economic warning signs that we've been taking a look at, such as those jobless claims and declining consumer confidence. So again, this is just one model with significant limitations, although this is the first time in almost 3 years that it has flipped into being a recessionary indicator. So very interesting stuff here. We'll have to see how the economy turns out in 2025. There's a lot of unknowns ahead, there's a lot of potential, and there's also a lot of risk. So we continue to see the economic indicators fairly mixed, with some like this GDP Now model showing a potential recession, while others like the ISM services showing a fairly healthy economy. With that, we want to thank you for tuning in to this week's market update, and we look forward to providing another update to you very soon. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.